cards note guide for today. So a credit card is going to be something most of us are familiar with, a plastic card that you can access your credit line with. And we know from last note guide with the credit basics that our credit line is going to be a predetermined amount of money that we get by opening this credit account. And we also call this the credit limit. So the credit limit is just going to be what is that maximum dollar amount. So if my credit line is $1,000, then my credit limit is $1,000. I can't spend more than $1,000. And when I get to $1,000, I have maxed out my credit card. And then we know for the open end or closed end, we are able to identify if this is a installment or a revolving credit. We know that this is revolving, that credit cards were a revolving type of credit. Interest is going to be the expense of using a credit card. And so we have our interest rate or our APR that's going to tell us how much we owe in addition to that principal amount that we borrowed. And we are going to pay back this interest every single month. Much like compounding interest with our savings or our investing tool, this interest is essentially going to compound because I'm going to be continuously earning interest that I would have to pay back if I still have borrowed money that I haven't paid back in full. Each month, I will have a new minimum payment that I have to pay off in order to be in good standing with this credit card company. So we can see down on this little chart that I could pay my full payment off of $1,500, or I could pay the minimum payment. I have to pay at least $30 in order to stay in good standing. But I can see that if I'm only making the minimum payment, it's going to take me quite a while to pay off my debt. So I would be paying for 11 years, only making that $30 minimum payment. I would pay over $1,000 in interest, end up paying almost double what my borrowed amount was. So we want to make sure that we are obviously at least paying that minimum payment, but we would like to be into a partial payment or a full payment if we can. That way we can lessen the amount of money that we are actually spending to pay off this debt. Credit cards can be used to help us in our financial management. And so we can see a couple ways that these are seen as a positive if we are managing them responsibly. So we are going to develop a positive credit history. I talked during our credit basics about how important it is to have a positive credit history and to have a high credit score. And having a credit card can help us build that. It can be a really convenient way to make some payments if we just don't have the money today, but maybe we'll have it at the end of the week. We can make a payment today and then we can go back and pay off that amount we borrowed before we earned any interest. Credit cards usually have more protection. So if you're online shopping or something like that, using a credit card typically have more protection policies in place if there is fraudulent behavior. That way they are not accessing your actual cash. And again, that's why they are safer for online shopping because they have those extra protections for fraud. And then there are some other benefits to using some credit cards. A lot of credit cards will offer you miles on an airline. They might offer you cash back. So you do have some benefits or some positive things that you could earn for using a credit card. Developing a positive credit history is going to have a huge impact on your future. And in order to actually develop that positive credit history, we have 4 key things that we want to make sure we're doing. We want to try and pay our balance in full every month, anytime that is possible. We want to pay off as much of that borrowing as we can. That way we're paying as little interest as possible. And we are paying it off in a timely manner. Paying those credit card bills on time, even if we're not paying off the entire amount and we're just paying the minimum balance, making sure that we pay those on time is a huge benefit. Knowing how different credit cards are going to affect your credit history, and then making sure you're staying up to date on those balances, making sure that you are not having any fraudulent charges on your credit card, and that you're aware of how often you're actually swiping that card. So some ways that we can have a credit card be a convenient payment tool: it reduces our need to carry large amounts of cash. People aren't often carrying $100, $200, $300 of cash anymore because they have the ability to use a debit or a credit card pretty much anywhere that they are right now. Credit cards are also really useful in emergencies, typically because you may have more of a credit limit that is higher than the amount of cash that you actually have in your bank account. So if you have a large expense, you have you have the ability to actually pay something off, even if you don't normally have that amount of money in your bank account. And then sometimes, depending on the situation, you may be required to have a credit card in order to hold a reservation. This happens a lot if you are going to be renting a car or if you need a hotel room. Most of you, this doesn't apply to because you typically have to be 18 to 21 to get a hotel room or 25 to rent a car. But if you're ever in one of these scenarios, a lot of times you do need a credit card that they can keep on file in order to rent a car or in order to get a hotel room. Alrighty, the other way was to protect yourself from unauthorized charges. We can see that we have the ability to report our lost or stolen cards. That helps us protect against fraud. If someone steals your credit card and you can identify that you had this card stolen on Monday and then there was a charge on Thursday, they're not going to fault you for that charge on Thursday because you identified that you had lost your card on Monday. And then a lot of them are going to have a maximum liability that you would have. So you may only be responsible for $50 if this is just some unauthorized use. But if you report that this card is stolen, or if the card number is used but not the actual card itself, then a lot of times you're not going to be responsible for any of the amount of money that was charged. And then if you are responsible for some amount, it may be pretty low, like $50. You are very rarely going to be responsible if that person charges hundreds or thousands of dollars onto your card. And then lastly, it leads to, I think there's actually one more, but it does lead to safer online shopping. We see that there is less liability for those unauthorized charges. That is part of that protection. And this all just centers around the fact that credit cards are truly safer than debit cards. They have more protection in place than the debit card that you have, which is attached to your checking account. This is just a chart where we can break down what is the best option if we are going to choose to use a debit card or if we're going to choose to use a credit card. So if I'm using a point of sale system, I am about to make a purchase, I could pick a credit card. A lot of times a credit card is going to require a receipt to be signed, and you're going to have that extra liability. Or you can pay with a debit card. The safety measures for a debit card are a lot of times they're going to ask you for a PIN number. And if you use a debit card, you often have the opportunity to ask for cash back. So if you need to be walking around with cash in your pocket, a debit card is definitely a benefit to that. And then those additional benefits, like I talked about, a lot of times you'll have airline miles. You might have some insurance that goes along with it. A big one is that a lot of credit card companies like Discover, they offer cash back. So you can either just have cash deposited into your account or you can use the money that you've earned through their organization to help pay off your bill. They're just going to be very low amounts of cash back and low amounts of miles. So you have to spend quite a bit of borrowed money from them in order to have some of those benefits. There are advantages and disadvantages to credit cards. So some advantages. A lot of these are going to be the recap, like the convenient payment tool for emergencies to hold a reservation, and building that positive credit history. The negatives are things that we have not yet really covered all that much, though. The interest that you are charged for borrowing this money can be very, very expensive, and it can add up very quickly. So you may not think that a 5% interest rate seems like very much money until you have spent thousands of dollars, and then all of a sudden you're paying a few $100s in interest. So it does add up very quickly. Depending on the credit card company, there may be a lot of fees that go along with this. Sometimes there are fees for using your card too much, not using your card enough, just a maintenance fee for having this card open. So we want to make sure we're reading the contract and seeing what those are. That way they are not unexpected on our account. Credit cards can be very dangerous if you are someone who gives into peer pressure, or if that card burning a hole in your pocket is tempting to you. It is really easy to just continuously swipe your card knowing that you have $1,000 credit limit and you have $1,000 that you could potentially spend. Using your entire credit limit is a really bad way and a really dangerous way to get into a bad financial situation. Alrighty, and then whenever we're looking at credit card offers, we have what we call a Schumer box. And a Schumer box is going to be an informational piece that kind of discloses the terms for this contract. And it's going to be put into this box because it's a better, more easy, like an easier way to see all of the information. And we're going to break down what these are so we see why it's important, because we'll know some of the details in our contract. And we're going to go through each of these lines individually for the Schumer box. So the Schumer box, the first piece is going to be the APR, or the annual percentage rate. And it's going to tell you that interest rate. It may tell you multiple interest rates. If the interest rates change based on time, based on product that you're purchasing, those interest rates do vary sometimes. So it's going to detail all of that. And it's going to just let you know that your final interest rate is going to vary depending on how credit or how trustworthy you are based on your own credit history. We're also going to have what we call a fixed or a variable rate. So a fixed rate would be one that cannot change over the life of this agreement or over your contract. Or it could identify that it is a variable rate. And this means that can fluctuate. So based on economic conditions, based on your improving or declining credit history, they could increase or decrease the interest rate that you are paying. Next, we have a term called balance transfers. And balance transfers are going to be whenever you are transferring debt from one credit card to another. So if I have two credit cards, I have a balance on both of them. I could transfer my balance from credit B to credit A, and now I only have one line of credit. I just have a lot more debt on that one line of credit. So I'm kind of consolidating where my debt is at. Rather than paying two different bills, I'm only going to pay one. And in addition to balance transfers, we'll also have a term called cash advance. And a cash advance is where I can take my credit card, I can go to an ATM, and I can pull out cash. And that's going to count into my credit line. So I'm basically borrowing on my credit line. I'm just pulling it out as cash rather than making an immediate purchase. Sometimes cash advances will have a higher interest rate, and sometimes there will be a maximum amount of cash advance that you can get. So maybe over the lifetime of my contract, so maybe each year, I can only pull out $500 through cash advances. Once I get to $500, I can no longer pull out any more cash. We might have something that's called a penalty APR, and penalty APR means that it is going to be a different interest rate that is charged on new transactions if you have any penalties on your contract. So if you have broken any of those contract terms, like making a late payment, like maxing out your credit card and trying to charge more than your credit limit, maybe you tried to make a payment, but you didn't actually have enough money in your account, so they had to return it. Or if there are some other contract terms that you have broken, you're going to get a penalty APR. So you're going to be charged a fee or a certain percentage for breaking some of these rules. It will tell you next, now that we have some of those interest rates kind of wrapped up, it'll tell you how to avoid paying interest on your credit statement or for your credit card. And this is just going to be pretty simple, paying your full balance by the due date. That is the only way to avoid interest. If you do not pay your full balance, it will tell you the minimum amount of interest that you're going to be charged. So depending on, maybe you bought something with a credit card, it was only $1. If your interest rate is only 1%, you're going to be paying 1 penny for that $1. That's not really enough for them to collect from you. So a lot of times they'll have a minimum interest rate. So unless you pay your balance in full, they're going to charge you at least 50 cents up to a minimum of $2 per month. That meaning that if your balance is too low to meet that minimum interest payment or interest charge, they're still going to charge you that, and you're still responsible for paying it. And then the Federal Reserve Board also just includes some credit card tips to help you manage your credit card through this website, and they identify that on the Schumer box as well. So it just gives the credit card holder a link to go to get some tips and some advice to help them manage their credit card debt. We are not going to go through this website and pull out some facts, mainly just because we don't have quite enough time. Next, now that we've covered that interest section, we're going to jump down to the fee section. That's the second portion of the Schumer box. We start out with any setup or maintenance fees. I talked about how some credit cards do have these. So some might have what we call an annual fee, which would just be a yearly fee that you have for having this credit card. A big seller for a lot of credit cards lately is that they advertise that they don't have an annual fee. So you don't have to pay a yearly charge just for opening this credit card. Depending on the company, you might have a setup fee. So you would pay this when you open your account initially, and then you would not pay it again. You might have a participation fee, so you just would have a monthly charge for every month that you have this credit card open. And then an additional card fee. This happens a lot with families or with married couples. If I have a credit card account in my name, I have the opportunity to take out a second card on that account in my husband's name or in my child's name. And I would pay an additional card fee for having a second person on this account. Some of these are going to be kind of a trade-off for not having credit history. So if you've never had any credit before, you don't have a credit score, you might have a high annual fee, you might have a setup fee or a participation fee, and that's just a way that a company can lower their own risk because they don't know how risky you are to work with yet. Next, we have some transaction fees. So this will tell you actually how much you're going to pay for those balance transfers and for those cash advances, along with any other type of transaction fee that you may need. A A lot of companies or credit cards will have a foreign transaction fee. That way, if you're traveling abroad and you need to swipe your card, you'll pay a small fee to complete that transaction, because the credit card company has to do a cash exchange. They have to change it from US dollars to whatever currency the country that you are in functions with. And then we wrap it up with some penalty fees. So you're probably going to have a late payment fee listed. If you do not pay at least the minimum balance by the due date, then you would have a fee for making a late payment. It will outline what that over the limit fee is. We talked about the over the limit fee in that top section. If you go over your credit limit, you're going to be charged a fee. This is where that number will actually be detailed out, as well as the returned payment. So if I don't have enough money to pay my credit card payment, what is the fee that I have to pay for making that mistake? And then at the very bottom, it identifies how they calculate your balance. So calculating your balance, credit card companies use one of several different methods. So they will identify what method they're going to use in order to actually calculate what you owe. And then we have loss of introductory APR. I talked before that a lot of cards will have a certain interest rate at the beginning, and then the interest rate might spike depending on certain circumstances. So this would tell you what would have to happen in order for you to lose that better interest rate. I'll scroll down to our last page of the note guide. We looked at the credit application process in our credit basics notes, and that's pretty much going to be the same for credit cards. We want to start by shopping around. So we want to compare different contracts, different interest rates, different terms, and looking at that Schumer box to identify which of these different credit cards is the best for me. We will fill out a credit application. That is the process that we talked about last time, giving them our personal information, and access to our previous credit history if we have any. And then kind of waiting to see if we are approved. Based on our credit worthiness and our trustworthiness, based on our credit history, they are either going to approve us for a credit card or they're going to deny us. A lot of times, if you are getting mail, you may have what we call a pre-approved credit card application. So companies just consistently, if they want to get more customers in, they might just run a quick test and see who in the area passes their initial credit check. If you pass their initial credit check, they might send you a potential application in the mail just saying, you're pre-approved for our credit card, fill this out and we'll tell you what your interest rate, what your credit limit would be like. That way they can hopefully entice you to start a contract with them. Some details about owning a credit card. Typically, you have to be 21 years old to open a credit account. If you are not 21, you can get a credit card when you are younger. But if that's the case, then you usually either have to have a co-signer, meaning another person who is going to take on responsibility for your debt if you are unable to pay it. Most of the time, this is going to be a parent or a guardian. Lastly, you could also qualify for a credit card if you have proof that you make enough income. So pay stubs or bank statements proving that you make a considerable amount of money, that your expenses are less than what the amount of money that you actually make, showing that you are able to afford those monthly payments if you were to have them. And then once you have been approved for a credit card and you start to use it, you'll get what we call monthly credit statements. And a credit statement is just going to be an overview of the things that you have purchased in the last month. It is really important that we look over this credit statement every month because that's how we're going to identify if our credit card has been used fraudulently. If you are not checking your credit statement, then you don't know if people are actually charging on your card or not. And then we're just going to break down the different sections of the credit statement. So we start off with a summary or account activity. This is just going to be the overview of the card, so we can see on the screen that it shows us our previous balance, how much we paid, how much we have purchased, and then our closing balance, as well as our credit limit. So we can see that his credit limit is $2,000. He started off the month with $535. He paid $450 of it, but then he charged quite a bit. Had some cash advances, had some balance transfers, and his current balance is $1,786. So he does not have a lot of credit line left. He used quite a bit of his credit limit this month. So he only has $200 left on his credit line. Next, we jump down into our payment information. So this tells us our new balance, our minimum payment that we owe. So what is the minimum payment that I owe for this month? Because I had different charges than I had last month, so my minimum balance is going to be different. And it tells us what day we need to pay by. It'll also, again, detail out our late payment. So what am I going to be charged if I make my payment late? And just reminding me about the interest that I will incur by making only the minimum payment. Let me clear this out of here so it's a little bit easier to see. Next, we have, again, just the notice to our changes in our interest rate. They put these on our credit statement. That way we don't always have to go back to our contract or always go back to our Schumer box. It gives us the most updated information. But it's going to, again, identify if our interest rates are changing and tell us what they are changing to. It will identify any important changes that I need to be aware of for my account. They have to notify me of these changes before they happen. And by putting them in my credit statement, that is how they are notifying me. So if I'm not checking, they are still notifying me. They cannot get in trouble for making these changes because they did tell me and it was on my account or on my statement. It will then detail out all of our transactions. So just like our bank statement, it's going to tell me a lot of times it'll tell us the time, but it's definitely going to tell us the date, the location, and the amount of every single transaction that I have made this entire month. So every time I swiped my card or used my credit card, they are going to break that out into a chart for me. And then I will be able to see the fees that I was charged as well. So if I was charged a late fee, maybe the balance transfer fee and the cash advance fee, because that is what Andrew, those were some of the transactions he made this month. So he's going to have some fees associated that add on to his current balance. And then the last sections, they're going to tell me my YTD totals, and we know that that means my year to date. So what are the total amount of fees that I have paid this entire year? It's going to show me how they calculated my interest and break that down into a chart as well. And that is really where we wrap up our bank statement. That gives us pretty much all of the information that we need to know for our credit statement. We are going to skip through this activity, and we will end on our summary page.